You've just been listening there to the Federal Reserve Chairman listing the economic challenges in the US as reasons for raising the interest rates today by 0.75%, which is the largest rate hike since 1994. And he made a forecast that there will be more rate rises to come. I want to bring in our global economic analyst, Rana Farrooha, for more on what this all means. Rana, good to see you. So how quickly things have changed, because just a month ago, the Federal Reserve Chairman said the bank would not raise interest rates by 0.75%. It seems the forecasts have been all over the shop.
100%. I mean, we are in a new era of tremendous volatility. And, I thought Powell did a pretty good job at sort of laying out the truth, which is that things are volatile, inflation is really out of control, and neither he nor any of the other central bankers really know where we're going to be in a year. It kind of reminds me of Treasury Secretary Janet Yellen saying, I got it wrong on inflation. I mean, it is a surprising time, and there are just so many vectors in play, from the war in Ukraine, the possibility of Europe cutting off Russian gas, commodities, and the commodities weaponization around the world. You see countries starting to exacerbate what is already a spike in food prices by hoarding food and grains. So there's just a lot going on right now. You still have the tail end of COVID playing out with lockdowns and supply chain issues in different places. So I just don't see us getting out of this anytime soon. The one silver lining, I would say, is that I already see, certainly in the U.S., I think this is true in many rich countries, and already has been the case in many emerging markets, that people are really cutting back on whatever they don't need. So I suspect that once the markets get the message that, look, this is a Volcker moment, the Fed is going to do whatever it can, I think that inflation will be reined in pretty quickly. I do think that as much as the Fed thinks that labor markets are running hot, I actually think that we're going to see labor pressure abate more quickly than we think. I think companies are putting in a lot of technology. So again, that's a wild card factor. There's just a lot in play right now.
It's interesting, Rana, as you're speaking, just looking at the markets, they dropped initially very slightly when the interest rate hike was announced, picked back up, dropped again, and then they've taken off as soon as the Fed Reserve Chairman started speaking. What does that tell you about how investors are feeling going forward, getting some more clarity today?
So let me start by saying that some of what happens in the markets at a time like this is about algorithmic trading. It's about the programs rebalancing based on certain words that are being heard from the Fed, certain rate increases they just sort of sell and then buy back. So some of that is really about the computers. Some of it, I think, is also about investors saying, look, I'm going to buy this dip. Yes, the central bank is pulling out of the markets. Some people are worried that that means that really we're just not going to see the kind of returns we have in the last few decades for some time to come. Others say, hey, I think that the U.S. is fundamentally okay, and I'm going to buy back into this market at a dip when it's cheap. I think we're going to see that story continue to play out over the next few months, and we really will not get a sense probably until early next year as to where the market is finally going to land and what the new normal looks like. Is it going to pull back ultimately to sort of a pre-COVID level? Is it going to pull back to a 2008 level? Where is that benchmark that we're looking to pull back to?
Yeah, exactly. As always, great to get your analysis, Rana. Farrooha, good to have you with us. And of course, we're going to have much more on this next hour with Richard Quest on Quest Means Business.